just a regular principal and interest top up or a line of credit. How to choose the right one for your increase of your mortgage. You are looking for a way to get more debt, to get more home loan for your project or for a purchase or whatever it is that you're looking for. And you're wondering, how can I make the right choice for the structure and also not have to pay so much in interest? Okay, there is a key to choosing the right type of loans. I'm going to break them down for you, pros and cons, and how to match your desired outcome to the type of loan that you get when you get that increase on your mortgage. Okay, because most people choose on flexibility, right? However, what you need to do is choose on strategy, and that's what I'm going to show you. By the end of this video, you will know exactly what the best types of loans might be for your particular outcome. Now, a caveat is that I am not a mortgage advisor. I am a financial coach and educator, and my job in this video here today is by the end, you will have really great topics and points that you can talk to your mortgage advisor. So you're going in educated, you're going in confident, knowing what types of loans seems to make sense to you for your own outcome. Now stay to the end. I am going to go over how to avoid what I call the revolving credit magic wand trap. Okay, many people, you might have heard out there that revolving credit is the perfect way to do your renovation or to get that loan and use it to buy a car and use it to do all kinds of renovations for your home, either a flip or something different like that. Now, it may or may not be the right choice for you. And so I'm going to give you a 5-point test to go through so you can know exactly, is that the right type of structure for you? So before we go too far into it, I want to make sure that you fully understand the terminology that's going to be used in this video. The first thing is we're going to be talking about different types of loans. And the first one is principal interest. I'm going to use a visual to help illustrate the difference between these different types of loans. Okay, this is a principal and interest loan. The yellow is the principal and the red is the interest. So the way that it works is similar. You're probably already familiar. Then obviously the amount of interest that you pay is based on how much principal you have. As you pay down your mortgage repayment, obviously you're going to pay down more interest first, then you pay down the principal. But in general, the idea is that as you pay down your principal, that means you're getting rid of interest because the interest is calculated based on how much principal you have. Okay. However, for example, if this principal and interest loan was on a fixed interest rate, that fixed interest would stay the same amount of interest. The interest rate wouldn't go up or down based on the amount of time that you fixed it for. So if it was 6 months, a year, 2 years, whatever, that's fixed for that period of time. However, you can choose for the loan to be on floating. That means the interest rate goes up and down based on the OCR and what the banks set their interest rates at. So when the fixed interest loan, principal and interest loan, comes off of its fixed term, it automatically switches to floating. So then you would need to refix it. So that's a principal and interest. Many people are very familiar with that. The principal and interest versus fixed interest versus floating. That's pretty simple. But let me show you a different one. So now we have here the blue. Blue is the revolving credit or offset. Okay. So if blue is the revolving credit offset, which means that you can, let's go with revolving credit, you can put money into the revolving credit. Okay, let's say I put some cash savings into my revolving credit home loan. That means for the amount of cash I have in this, I'm actually not paying interest. Okay, so if I put more cash in, then I'm not paying interest. Okay, so that is how you can reduce your repayment. You can reduce the amount of time it takes because you're putting money in, effectively paying off that loan. But the beauty of a revolving credit, it's revolving credit, right? So I can take my money out as well. But when I take my money out to pay for a renovation or buy a car, then I now have to pay the interest on that, okay? And because of this revolving way that it works, for example, if I take more cash out, that means I need to pay the interest on that. This loan, the revolving credit loans, are on floating because you're revolving the ability to use and borrow against this, use this loan. So the interest rate is going to have the ability to fluctuate up and down. You can severely reduce your interest rate by putting more cash in. So obviously there's not as much interest as I need to pay because I have cash in, okay? Now there are other options, for example, like an offset, all right? The difference between a revolving credit and an offset is your offset is offsetting between cash and another bank account, okay? So I might have offset loan instead of it being revolving credit. This loan stays like this. You don't put cash in it, okay? It stays like a loan, like what you're used to, but it can offset any cash that you have, which means that if I have any cash in a loan in another bank account that's offset against my offset mortgage loan, that means I'm not paying any interest. So if I am offsetting against these two bank accounts, that means very similarly, that interest is not being applied to this home loan, even though this is money in a separate bank account over here, okay? So that's the difference between the offset and the revolving credit. So how does it work when you get a top up? So let's reset. Okay, let's say you start with your home loan, and to make it simple, it's a principal and interest loan. Let's say you are paying down this mortgage over time. So you have some principal that you're not paying and some interest that you're not paying. So now you've reduced this loan down because you've been paying it over time. But now you have equity because the value of your home has either stayed the same while you're paying it down or went up. But the difference between the loan and the actual value of your home, there is a difference. So now you can use some of the equity. You get a top up, which is also might be called a home equity loan. So now you can either get it in another principal and interest loan, okay, which increases that loan again. Now it might show up as a different facility, which means it has a different back end, either 2 or 3 numbers. It might have the same account number as your original loan, but a different suffix, which is the last 2 to 3 numbers of your loan number, account number. So that means that you have now added another loan, but it's against the same property and it's based on the amount of equity. Now this additional loan, you're obviously adding a loan, can be principal and interest, or it can be a revolving credit. So if you want the ability to put money in that account and then not have to pay as much interest and then borrow it again, having to pay interest, okay? It can also be an offset loan. For example, as we talked about earlier, you can have an offset loan, this money to the side, which is in a bank account that's linked to your offset. And now if you have money in that account, you're not paying interest on that portion of the loan that has the money. That's the same amount as money that you have inside of your bank account that's linked to your offset account. Okay, so now let's go over what options make sense for the outcome that you're looking for. So the first outcome we're going to look at is paying down your mortgage faster, reducing your mortgage interest. The best option for you is the offset. And that's going to be for, I would say, around 90%. It's not science. I'm not giving you research, but most people, vast majority of people are going to do better with an offset because you have the ability to have multiple bank accounts linked to an offset home loan, which means that you can keep the clarity of how to manage your money, seeing where your money is going, and all of those things while using the same money that you have in your bank accounts to be able to reduce the interest that you have on your offset home loan. So that is the best option because you have what I call the 3 C's when it comes to your money. You maintain those 3 C's and they are critical to your financial success. Those 3 C's are, first, clarity. You need absolute clarity. You cannot sacrifice that so you can see what's happening so you can be in control. That's the second C. You need to be in control of your money, you being able to make decisions you steering where your financial life is going, so you can have the third C, which is confidence. Be very confident. You should not be guessing, I might be hitting my financial goals, I might be heading to where I'm wanting to go. No, you need to be very confident that you are heading in the right direction with your money and with your mortgage and with your financial freedom. So the limitation with the offset is that they're only available at 3 banks at the moment, which is BNZ, Kiwi Bank, and Westpac. Now, each of those banks have their own benefits and pros and cons to how they work. So talk to your mortgage advisor around which bank, if you're like, yes, that's what I want to be able to pay my mortgage off faster, I love the sound of an offset. Talk to your mortgage advisor about the pros and cons of that. Obviously, there might be some break fees if your current loan or loans are fixed in a fixed term at the moment. However, have a chat, and then there are limitations. Different banks allow you different amount of bank accounts that you can link to your offset, whether or not you can have 1 or 2. Many of those banks, the BNZ, particularly Kiwi Bank, I believe, and potentially Westpac, will let you have more than 1 offset if that's the right choice for you, but talk to your mortgage advisor around that. The other benefit of this is that it works well with your behaviors. Having multiple bank accounts has been proven that is one of the most successful ways for you to manage your money, so you know what's happening. You don't have to track every thing that you spend your money on. You don't have to budget that often because you are organizing your financial life based on the bank account buckets, okay? And so being able to use this is a huge advantage. The next outcome that we'll look at, which is better long-term savings. So if you have an amount of money, if you have inheritance or a windfall or a certain amount of money and you want to save it long-term, you're not expecting to use it for renovations or buying a car or whatever the case may be. You want it to sit there and help you, and you have a mortgage, right? So if that's the case, why not use that money to offset on your mortgage, right? So the revolving credit is your best bet at this point. So you want to be able to put that money into the revolving credit. The reason why I say this instead of an offset is because in a revolving credit, all your money is in one bank account. It's in that revolving credit loan account. That means when you take money out, when you put money in, you have to have a different set of management. So budgeting, a spreadsheet, something, and track every single transaction somewhere else so you can be able to see what's happening. Remember the 3 C's. You need clarity so you can have control and then confidence. So you lose out on the clarity when you have a revolving credit if you're trying to use it for multiple transactions. You can't see what's happening, right? And I know that's it's gaining in popularity as a strategy to be able to pay down your mortgage faster. However, again, if you don't have the 3 C's, you're not going anywhere. You're just spinning your financial wheels, okay? And if you've had one, you know what I'm talking about. And so when it comes to, it's not great because of our money behaviors usually aren't that disciplined to keep the clarity that we need to really have the control and steer our finances and our lives the way that we want to. So because of that, if you're trying to pay down your mortgage faster, use an offset. But if you have cash savings that you just need to have it saved, do a revolving credit. It's perfect. And many of our clients when you work with us, there are many of our clients that have both a revolving credit for their long-term savings and a offset account for their mortgage debt reduction strategy. So you can use more than one, but talk to your mortgage advisor about how much. Both the offset and the revolving credit accounts are very important to get the size correct because they are both on floating rates, which means they are higher than the fixed interest rates. So you want to make sure that you get that size of it correct. Okay, ultimately what you want to do is make sure that you have the size of your revolving credit or offset, then the size of how much you can save over 1 year. So whether if you have fixed savings that you want to save for a while, you can have it that same amount size. And then maybe if you want to add additional savings into it that you just want it to sit there, like your emergency fund, then maybe you make that revolving credit a little bit larger to have space for any money that you're going to save as long-term savings into that revolving credit as well. So the next outcome that we're going to look at is funding a defined projects like a renovation or purchasing a car, or you just want to get a top up for some big expense, then that would be best as a principal and only loan, because you are going to get that money and then that project's over, right? As soon as they give you the loan, you take the money, you do the purchase, it's over. Now, the only caveat would be is if you are renovating for multiple projects. Maybe each project is defined, maybe the multiple projects are defined, but it's going to be for a prolonged amount of time, a year, 2 years, 3 years, 4 years. Then yes, a revolving credit might be good for you, or an offset, okay, depending on, as we talked about, the pros and cons of both of those. But if it's going to be a defined project, which is short term, you're just wanting to redo your bathroom, for example, then that would be best serving you as a principal and interest loan and maybe fixing it for a certain amount of time. So then you can say, hey, look, I am going to take a year and I'm going to top up my mortgage for this amount, and I want to pay that down over 1 year. Then you can use the 1 year fixed term, or I'm going to pay that down over 2 years, or I'm going to pay that down over 3 years. And you're going to use that as a fixed term. You can fix it as a fixed term, and then that gives you the clarity and control about how much your repayment is going to be and how fast you can pay it down. And if you do some upfront maths ahead of time, then you know how much you can borrow and how fast you can pay it off. Especially if you're using mortgage debt reduction strategies, then you can go ahead and make some plans for how to pay that down quickly. If you're using what we call a seed capital, which is an amount that you save up every year to put a principal only repayment onto your mortgage every single year, so you can pay down that principal quickly, which means you're not paying as much interest, which means you're paying the loan off faster. Okay, so if you are doing that, then it makes it a no-brainer to go ahead and get a fixed loan and pay that down in a certain amount in that time, because you know you're saving that money. Now, if you are saving that money, you don't have another offset or revolving credit, and you know you are going to need to be able to offset that money, then yes, you can get a revolving credit or offset loan to be able to save that lump sum payment into, and then make the lump sum payment onto your principal and interest loan. Now, the other outcome is an emergency buffer. So we kind of talked a little bit about it earlier, not directly. So when it comes to emergency funds, you can do an offset or a revolving credit, because again, that money, you're saving it, it's sitting there for the emergency. The risk is if you have to use it too many times in 1 year, then remember the size matters for the offset and the revolving credit. So if you don't get to be able to put as much money into the revolving credit or have as much money into the accounts that your offset is linked to, then you're going to be paying more interest. Okay, so you want to really have a good conversation with your mortgage advisor as to make sure you get that size correct on when you're going to have emergency funds. If you have a chunk of money already sitting there, again, you can do either just a revolving credit, put that money in, or you can do both revolving credit and offset depending on your situation. So the next option or outcome that you're looking for might be you wanting to use your equity for an investment. Now, it's not really kind of a one type of account. You're basically looking, how can I structure this when you're looking at, for example, maybe your first top up is going to be for the deposit on that investment property, okay? And how to structure that, as we talked about the pros and cons of the different types of bank accounts, based on how fast you can pay that down, based on what types of structure when you have the full mortgage loan. So for example, if it's a new built investment property, then you might be getting a top up just to start the build, and then you're going to get the construction loan, where then you maybe have drawdowns over a period of time, or there's different ways that you can do that in new build. Or if you're going to just get a full-on loan to buy an investment property and you have your deposit already, or you use the equity as a deposit, that really is a whole conversation around whether you're going to split those loans, have multiple loans for that investment property, and how best to do that. Again, if you have a mortgage debt reduction strategy, especially if you're working with FutureBound, and we're going to be looking at things like How much are you able to save as your principal only repayment each year? Do you have some savings you would like to offset to maybe put in a revolving credit in addition to your offset, helping you to set up different multiple bank accounts that you can offset and link to your offset home loan, and potentially a portion of that as well as principal and interest loans. So that's a bit of a mixed bag when it comes to that, but you want to make sure that you're looking at the pros and cons of each. Have a chat with your mortgage advisor to really understand, who can look really at your situation fully and be able to understand exactly how best to structure that. And now the last outcome is debt consolidation. So if you're trying to get a top up to consolidate, you're going to get a top up on your mortgage because you have some equity, you're going to access some of that equity and then pay off higher interest loans somewhere else, short-term debt, your car, your store loans, your personal loans, those kinds of things. Now, in general, I do not suggest that a debt console is perfect for every situation just because you have equity. Potentially you could be using it in better ways, or you could be paying down your short-term debt in a better way. Now, if you have a large amount of short-term debt, it does make sense sometimes, especially if you're going to now then enact and use and execute a mortgage debt reduction strategy, to go ahead and do a debt console and put that on your home loan. The problem I do want to say, because I can't, even though it's not about debt consoles, but I cannot talk about debt consoles without saying that you want to be careful, because doing a debt consolidation into your mortgage multiple times is one of the hidden traps that keeps people with a large mortgage for a long time. And you don't want to find yourself in your 40s, 50s, 60s, sometimes 70s with still a huge mortgage when you're in the time of life where you want to start having fun and living this lifestyle that you dreamed of, but you can't because now you have this huge mortgage still over your head. Okay, so be very careful about if you're going to and when you do a debt consolidation. But if you're going to do one, then you want to make sure that you are looking at, again, how much is that debt that you're trying to consolidate, and can you just put it on a principal and interest loan so you can just pay it down quickly? Again, using that idea of saving up a principal only repayment, paying it onto that loan each year once it goes on to the floating interest rate, so you can fix it, for example, for a year. Once it comes off of the fixed interest rate, you can take the savings that you have saved for a year and pay it as a principal only repayment onto your mortgage. Now, again, many times you already have another mortgage, because again, this is a top up. So you can make sure that the overall structure of your lending, the new top up lending and your existing lending, makes sense to where you can be able to do that either with an offset or revolving credit, or both. Now, you have made it to the end. I really would love to show you how, just talk a little bit more about the revolving credits, because remember I talked to you about it is becoming popular to just, everyone thinks the best way to pay down my mortgage is a revolving credit. Just get a revolving credit. So many of our members and our membership, when we work with them, they have a revolving credit, but they do not understand how to use it. It's not the right size. They're paying too much interest, or it might be too small, which they could be offsetting more. Not understanding exactly the benefits and the pros and cons of the revolving credit really puts you at a disadvantage. It can be a very risky product. So you want to make sure you fully understand it, okay? And so I just want to make sure that you have a way to understand exactly, is the revolving credit the best for me? Should I be looking at other things like an offset or a principal and interest loan? So let's go over these 5, I call it the 5-step revolving credit alignment test, and you can just answer yes or no to see if this is the right one for you. So the first thing is it aligned to your outcome? Okay, so are you using it as because you have variable income, or maybe you're using it because you're intentionally trying to save, or you have a large amount of savings, or you have a long-term project like a renovation or multiple things for a long period of time that you want to be able to access cash, put money in, take money out, but over the long period of time, you are able to bring down that revolving credit and not pay too much interest over time. So that's number 1. Number 2 is, does the size actually match your annual capacity to save? Okay, so remember, you want that revolving credit to get the amount of cash in it to get to the max, as close to the max within a year's time as much as possible. So if you're having a revolving credit, but you're having money go in and out, in and out, in and out, and over a year, it never actually reaches the max, that revolving credit is too large, which means you're paying too much interest, right? So you might want to talk to your mortgage advisor about reducing that facility. You can take a portion of that revolving credit and maybe make it a principal and interest loan. Or potentially you need both, an offset and a revolving credit. I don't know your situation, so talk to your mortgage advisor, but that is a sign that that's not the right size for you. Equally, if you have a more money saved in 1 year than what your revolving credit size is, then you actually have a revolving credit that's too small. So you want to look at how much can you actually save, and are you reaching that max without going over? That means that's the right size for you, that I can put them out. So that means effectively your interest rate on that amount that is in your revolving credit is 0, right? If you've reached the limit. So you want to make sure that you're actually having the right size. So number 3 is, do you have clarity? Can you maintain clarity on your cash flow with all your money lumped into one account, right? Like I said, many of you, the answer is no. When you have one account, even just a regular bank account, any bank account, if you had just one, you have to track every single dollar. It's a lot of work tracking every single transaction. And then if you have other people like you and your partner making transactions, then it gets really, really foggy, right? And you don't know what's going on. You are missing out on the number one key for financial success, which is clarity with your finances, okay? If you have no clarity, you have no control, and you're not confidently steering your financial life to mortgage and financial freedom. So number 4 is the balance trending up or down. We kind of talked about that before, is that if your balance is about staying the same, but it's less than the limit on your revolving credit, not the right size. If you know that you're actually putting enough money in to where the balance is trending up or down, then you can see how much is it too high, is it too little, or is it exactly correct, okay? How much available is how much money you have in your account, and your balance is the mortgage loan portion of it, okay? And so you can see how much is available, is that meeting the amount of your revolving credit? And number 5, the last one, is would a different structure give you the same outcome, right? Is there something else that's less risky, like a revolving credit, that might work well for you? For example, using an offset, which gives you more clarity, but also you can reduce the interest rate. Now, something that I did not mention earlier is with a revolving credit, as you're putting money into that revolving credit account, your repayments go down, okay? Because it's based on how much interest you're paying, so your repayments do reduce. But with an offset account, your repayments do not reduce, just the portion of your repayment that you pay, it stays the same, but when you have money that's offsetting, more of that repayment gets applied to the principal, okay? So one of the considerations is, are you looking for a reduction in your repayments? That might work well if you can keep clarity to use a revolving credit. But if you don't absolutely need a reduction, you just want more of that money of your repayments going towards your principal, and that's fine, then that offset might work best for you because you have that clarity as well, which you lose with the revolving credit. Now, if you already have a revolving credit, don't worry, don't panic. You can make some changes, okay? So just review over the last 12 months. Is your balance trending up, down? Do you have enough? Does it seem like it's the right size? And so you can have a chat. Like I said, you can reduce the limit. Potentially, you're gonna have to talk to your bank, potentially talk to your mortgage advisor about increasing the limit if you need to, maybe potentially splitting off some of that and getting a principal and interest, or adding a offset if you're at one of the 3 banks that have an offset, the BNZ, Kiwi Bank, or Westpac, to be able to add that to your overall structure that matches your goals. Ultimately, it's all around, there's no good or bad mortgage loan. It's all, the mortgage loan itself, any home loan, is a means to an end, and your end is mortgage and financial freedom, however that looks like for you, with clarity, with control, and with confidence, you being able to get to that dream lifestyle of yours. So make sure that you are not trading that off just because somebody said you should have an offset. Okay, it's because financial confusion is expensive, right? But clarity is powerful. When you design your loan structured with intention, you protect your timeline and your control, right? So create that control, create clarity, and create your freedom.